what we're here to talk about is the intersection between accounts and tax. To start the conversation, what I want to talk about is what is an account, right? An account, if we're going with a specific definition, is really just a ledger or a history of transactions that you have, right? So when people think of an account, it's really, they're thinking about it as the actual asset, they're thinking about it as the actual product. But what I want to differentiate is the account is just the way of understanding the evolution of a financial product or financial asset over time. And the reason I'm making the distinction is because if you look at the US tax law, right, this is the definition of a financial product or service. You can find this, there's a link at the bottom of the actual tax code that this is pulled from. But the point to bring up here is that financial products are pretty complicated, right? And we kind of use a lot of terminology to kind of, that interchange that should probably not be as interchanged so that you understand more of what you're dealing with, right? With a financial product, right, I want to recap a little bit about like how it operates. So at an earlier presentation, I went over this idea of like the pendulum of finance and just the three core concepts you need to understand in order to understand finance in general. And as the recap, it's you have a gain, a loss, or no change whatsoever, right? So a gain is any increase in value, a loss is any decrease in value, and a neutral is no change in value, or there's a transfer from like one account to another, and you're just overall break even, yeah. So what I want to start with in terms of the accounting is balancing a checkbook, right? And the reason I want to bring this topic up is because I feel like it's one of the skills that are being lost over time, right? We're not really teaching it to younger generations effectively at a younger age. And I feel like as we get older, if we learn something, it's kind of we're learning little pieces that we're supposed to bring all together to kind of understand how to do this task of like balancing a checkbook. But the core benefit of like balancing a checkbook or balancing an account in general is that you're able to connect your like daily living expenses to a larger financial goal. And if you're able to do the basic activities of balancing an account or a checkbook, you're able to form that bigger picture of like, this is what I'm doing on a small scale, but on a large scale, how does this actually connect to everything I'm working on, right? I'm gonna share my way of balancing a checkbook, and I feel like it's a little bit unique. There might be stuff that doesn't make sense to others, so just take what makes sense in your life, right? At the highest level, there's two things that I track, revenue and expenses. And I'm capturing revenue as credits, so anything that you are taking into your life, any money coming into you is revenue. Any money that you're spending out or going out of you is an expense or a debit. So with revenue specifically, there's two aspects to it, and there's positive and negative on actually both sides. So even though money coming in is supposed to be added value, what I consider added value is two things. Money actually earned, so if you go work for a company, you get a paycheck, that's money coming in, right? Investments that you get interest or anything from that's money coming in. What I also consider revenue is money that I lose through investments. So why I track it that way is because if I lose money through investments, it's not really like I ever really had the money to begin with. The reason I don't track it as an expense is because investment loss specifically is not like guaranteed, or it's not something that's stable. So it skews your understanding of what your real expenses are. So it's an investment loss is really a volatility on your income and not an actual expense. So even though it's a minus on your account, it's not actually an expense that you're having, it's just less money that you have coming in. That's why I make that distinction. And in terms of expenses, there's actually two categories as well. And the second category probably doesn't have a lot of things that fall into it. But obviously when you spend money, when you buy phones, food, whatever you have in your life, that's simple, right? That's, you're spending money to get this product or service. The other thing that I categorize in this is refunds. So if like I buy something and I return it, I don't really consider that an expense because I never really spent the money. I just got the money back from returning, like if you go to return a phone or return like clothing or something, right? Like you spent it, but then you didn't really keep it. So like, does it really matter? So for me, it doesn't. So that's why I keep it on a positive expense. And I see some people scratching their heads. Does anyone have a question? Yeah, so Yeah, so expand upon that, because I realize why the positive and negative is kind of confusing a little bit. So on the left side, the revenue is all positives, right? So positive plus a positive is positive, right? And positive plus a negative is, if the positive value is greater, it'll still be positive, but if it's negative, it'll turn negative, right? With the expense, a positive expense is minus, and a negative turns into a positive. Yeah, this is for personal finance, just yeah, it's not for official like tax purposes, and I should probably preference all this. What I'm gonna say is about that. Even the concept of revenue, income, profit, like all those terms on a financial official company or like business sense, it means something, but I'm using it to mean something else here.
Yeah.
Needs and want, would Starbucks be a need or want?
What, Starbucks?
It depends on your personal situation. Sit down with the person who invited you, or come talk to me, and we can figure out a solution for you.
I don't know your nationality, but you look Indian, but you eat a lot of pizza.
I do eat a lot of pizza.
Yeah.
Pizza is
Definitely not Italian.
Where? Oh, you are looking at it?
Yeah.
I didn't want to bring it looking into
pizza,
it.
pizza,
Oh my
pizza,
goodness.
pizza.
Pizza time.
I am from New York.
Excel.
Yeah, this is just screenshots. The whole spreadsheet is much bigger. I just let you know. So.
Oh, no, thank you.
Oh, thank you. And also, these types are just types that I've come across for my personal life. This is the way that I want to track it, but it's not anything universal whatsoever. We understand what expenses are and what revenue is, as I've described it, right? What I want to expand on in the revenue aspect a little bit more is the types of revenue that you can have. And I want to specifically contrast active income from passive income. And you can think of active income how I tracked it in terms of like work, in terms of I'm going to a job, I'm trading my time for money. This is, if I don't work, I don't get money, right? Passive income is the opposite. No matter you're working or not working, you have money coming in. And if you notice, I totaled them separately. So my income from my job is in one row, and the income from everything else that I have is in a different row. In terms of understanding becoming financially independent, right? The whole point is that you want your income passively to meet or exceed your income actively. And at that point, you can kind of say you're financially independent. If you notice, like my other income's not stable, like my work. So as long as you're tracking that on a general level, like even whether it's by month or by year, if it's on a time frame that you can understand, that's all that matters. So for the year, if you make all your money in 1 month and that equals your steady income from your job, as long as you're what's the word for it? Budget it out, but like there's a word for when you, budget, I guess, is the word, but as long as you budget out throughout the year, and you're like being smart about like when you're spending your money, and you're actually, if you get $100,000 in a month, you just don't blow it in a whole month. You like save it and use it effectively throughout the time. It's net versus net. Yeah, I consider after tax, because I don't consider money that I get before tax my real money. Investments is a very broad term, right? So when people say they get money from investments, they could really mean they get money from anywhere. But in terms of the investments specifically, it's stocks, mutual funds, bonds. I do personal loans. I have royalties that I also invest in. Cryptocurrency is also another one, but there's a whole basket of investments that go into it. I'll say that life is one big risk, and if you don't take any risk, then life's not going to really work for you. On a specific level, I think everyone, the investments that anyone should do individually is a personal choice. So it's learning more about what risk level you actually resonate with, and finding the investments that work in that risk category. So understanding like active versus passive income, right? The types of income. The next thing I want to talk about is revenue quality. If you notice, like my revenue here, in January I had a very large number of positive, right? And in August I had a very large negative. So if you care about having a steady income, you have to make sure that your revenue on a monthly basis or on any time frame, weekly, monthly, or annually, is stable enough for your needs, right? For me, I kind of understand that money comes and goes, so I don't really get attached to it. And as long as on average over the whole year that I know that I'll have money when I need it, I don't really care if I have a big gain, a huge gain in one month and a huge loss in another month. Just make sure you know what type of income and revenue that you're looking for, and making sure that the financial products that you have meet those needs, right? Going on to expense types now, there's two main categories that I track, direct and indirect. So direct is directly from my checking account or any sort of bank account that I have. Anything that's directly debited, I track as one category, and the other category is indirect, using credit cards, using any sort of credit in general. And the reason why I track this is because I think going into the future, everyone's going to start using more credit, more electronic forms of payment for everything. So understanding how much you have in that category will let you know like what's happening with your money and how it's transforming, right? I try to do everything with credit, and then I pay my bill right at the end of the month, right? I feel like that's the thing that everyone should do, but because everyone comes from a different financial background, they might not be able to do that. I would say try to cultivate that habit of actually using credit and paying it off, as opposed to just not being credit averse and saying, I want to pay cash because that's all that I know. So it's credit score, it's just financial practices in general, like being able to be more comfortable doing stuff with money is important. And we've talked about revenue, we've talked about expenses. Now, what I want to talk about is this idea of real income, right? So when people talk about income, they're really talking about the paycheck they get or whatever money that they get in. But the reason I'm saying real income is because this is the money that is adding to your net worth, right? All of your revenue coming in and your expenses going out, the money that you have left over from all of that is the money that categorizes your net worth. It's the money that you actually have at the end of the day, right? We have the revenue that I showed you, the expenses that I showed you as well. So if you add those two together, that's the real income at the top. The thing that this builds into is, like I said, net worth and versus income. So also in a previous presentation, I talked about the power of wealth and what an income gives you versus what a net worth gives you. What I do with this money, this number that I just calculated, is that I calculate my net for the year. So I do this on a monthly basis, right? And each month, whether it's increase or decrease, I add it to the total for the year. And if you notice in the beginning of the year, it's like this only 1 month, so my net is just that. But each month, I calculate my income and then I add that to the previous months, and I get a running total of my income for the year. The main thing that I use to track this for is income to expense ratio. And I think this is a very powerful number that people don't give enough credit to. What goes into it, right? So your expense on a monthly basis is what you need to live, right? And your income is how much that you have saved after you spent all your expenses, right? So for January, for example, right, the income to expense is 8.48, right? So what happens is that the money I saved is 8.5 times the money that I spent. So if my expenses stayed at $2,300 forever, I just saved 8.5 months of expenses that will last me 8.5 months. On the contrary, my expenses for August was $7,700. I lost money that month. So what happened is I lost 4 months of a savings that I won't have going into the future. Using this number, you can calculate how many months that you're saving and how many months earlier you can retire, or how much you can like plan your financial future based off of your current expenses, right? The whole thing is that this depends on is kind of financial planning. And if you notice, like, this is not all of my expenses, but I just put some stuff for visualization purposes. There's lots of things that we have to do at different points in the month. What I do is one day every month, I'd spend, for me, it takes 2 or 3 hours. For everyone, it depends on the level that you put into it, how much effort you want to actually track it. It could be as little as 10 minutes, honestly. What you do is you go through all of your accounts, you figure out what you owe, how much money you have coming in, and you schedule everything out. If you do this consistently, you'll never be late on a bill. You'll always have money when you need it because you're planning for the future. And it gives you financial stability and peace of mind to say that I know what I have and it's effectively being used to do the things I need to. So at the beginning of the month, right, let's say that you have $5,000 that you have from income and you have $2,000 that you have in expenses that you have to pay at various points throughout the month, right? You know that you have $3,000 left over to do stuff with. So if you don't plan ahead, you wouldn't know how much you have, and if you don't know how much you have, you wouldn't know where to put that money. So because you know in advance you have $3,000, you can say, I can move this money to a more profitable account or an account that's safer or gives me more peace of mind, right? And it's be able to use your money more effectively in the accounts that work for you. I was just about to say that. That's why you have savings and emergency funds, is to cover the months where your expenses exceed. And then you replenish it once you have more income to come in. So always pay yourself first, right? That's where that comes from. Calendars are great for certain people. I actually don't have a calendar like this. What I have is a list of accounts, and I just do it every month at the beginning of the month. We talked about revenue, expenses, and income, and how you can understand on a small scale like what you're spending and what you're getting, and connect that to a larger goal of like over a year, how many months am I saving of my life in going into the future, right? What I want to talk about now is actually the different types of account, and there's 3 categories that I feel like everyone should know about. There's taxable, tax deferred, and tax free, right? Most people have accounts that are taxable. And the biggest accounts that people have are checking and savings accounts, and obviously a house if they own a house. And then if they do have investments, that's the type of investments that they have, taxable investments, right? When you work for a company and you have the ability to contribute to a 401k or a Roth 401k or a 401k, you can get access to the others, but if you don't work or if you don't have steady income from a job, and you can't really contribute to those, right? You can have an IRA, but then an IRA has marginally better benefits compared to an individual investment account. And the thing about retirement accounts in general is that they have a lot of limits on them, right? The biggest limit is that you can't touch the money before 59 and a half or actual retirement age, which is 62 or 65. That's why having an IRA is like, it's not giving you the freedom that you need to, right? Taxable accounts, right? The money that you get in is taxed and the money you get out is taxed. Everything about it is taxable. There's no benefit whatsoever. Tax deferred is you don't pay tax now, but you pay tax on everything later. There's very little benefits to that, and the biggest thing is that if you expect to be in a lower tax bracket in the future, tax deferred helps you, but no one can say what tax will be like in the future. So that's why for me, I always prefer to pay tax now, because I want my money in the future to be tax-free. Always, right? So for tax-free accounts, if you have the option to do Roth 401ks or Roth IRAs, those are the best types of retirement accounts, because you pay tax now, but your earnings and the money you take out, all of it is tax-free at the end. Now there's a special type of account called 7702, and we're going to talk about that a little bit more. Before I bring up that type of product specifically, there's this big confusion, I feel like, that society forces us into, in the sense of like, there's technical terms for products and then there's layman terms for products, right? So when people talk about retirement accounts, right, do they really know what actual product it is under the hood? Because a retirement account's not a product. A retirement account is just a category of products. It's a type of term that people use in order to say like, oh, I'm saving for retirement, right? But what happens is that all of the financial products that actually have tax benefits are actually tax codes that are in the US tax law. So for example, like 401, 401k, 403b, 403, whatever, all of those accounts are actually from the tax code. And there's a huge section, if you want to read all the legal terms that go into it, that represent that. In terms of 7702, in terms of the tax law, it's categorized as life insurance and long-term care. However, the tax benefits that you have in terms of cash savings that is involved in this type of product isn't conveyed to the public fairly. We're here to talk about the account that everyone needs, which is a 7702, right? And there's lots of different things. As I said, 7702 is life insurance, but there's been a huge evolution of life insurance over the years, and the most recent type of life insurance is called IULs, and there's lots of different companies that have this. I wouldn't say that there's one product that meets everyone's needs, but depending on your needs as an individual, there will be a product that fits in this tax category that can work for you. There's 4 main components to what makes this account or product a great account to have. There's safety, flexibility, tax savings, and growth, right? So to go into each of these in order, right? The first aspect of safety, right? You never lose money in these accounts. So the way that the accounts works, there's 2 aspects to it. There's the actual life insurance death benefit, and there's the cash value that you have access to while you're alive. The safety that this product gives you is the protection that whether you're living or dead, the people you care about, whether that's yourself or others, the others that you care about, they're all protected, right? And this level of protection is the minimum foundation that everyone needs to start with before they can actually go out and say, invest in more risky, non-guaranteed options, right? There's nothing guaranteed in life, right? So in order to protect you from that, you need to have something like this. The second category is flexibility, right? Being able to use your money on your own terms, use it when you need it. When we talked about retirement accounts, 401k, IRAs, all that stuff, you have the big limit. You can't access this before you're a certain age. And on the contrary, right, if you still want to invest, you can say, oh, I'm doing an individual investment account with stocks and bonds and stuff, right? There's no tax savings in that. So being able to use this product to save your money tax-free will let you have a greater value of it and be able to access it. I know B also mentioned that like a scenario with one of her clients where he wanted to use the money and he wasn't even sure that he could, even though he had the product. So imagine people who don't know what happens, right? Think about if you had $30,000 in the bank. Let's say you needed $60,000. You could spend your money from the bank, whereby you don't have any more, and then take a loan for $30,000 as well. But then the amount of interest that you have to pay on that is ridiculous, right? So what happens is that in this product, you can still have your money and you can take a loan out against it. At the end of the day, you don't have to like build back your savings. Your savings is still there, but you're just paying yourself back in the sense that you have to worry about someone else coming after you for the money that you took out, right? You took out your own money, so there's a lot of flexibility in that. The next one is tax savings. So for tax-deferred 401ks and IRAs, right, you don't pay tax now, but you pay tax on everything in the future. So in this case, right, 7702 is funded with after-tax money, so you do have to pay tax that you're putting into this. However, it grows tax-free, and all of it is tax-free when you take it out. And there are different products that work differently in the sense of it has different limits on like when you can take money out. The longest term is 10 years though, without any loan charges, right? Obviously this doesn't affect the tax component of it, but the biggest thing on the tax level that this affects is that if you put too much money into it, it crosses the threshold and doesn't become life insurance anymore. It becomes an actual investment account, and it's called an endowment, a modified endowment contract, right? So as long as you don't hit that criteria, all of this is tax-free. And if you work with a competent advisor or competent tax professionals, you will not get into that scenario. But there are people out there that are only in this for the money, so they're not actually worried about getting you access to the value that you need. So just be careful. I'm giving this knowledge as a public service, but it's not official financial advice. You need to either talk to me directly or talk to someone else who is a certified tax accountant or a financial advisor or financial professional to get all of this content specifically in your situation. And then the most important aspect, or like the most thrilling aspect of this product, is that there is growth potential, right? With all the different types of accounts, there are different returns that you have. What this does is at the minimum always beats inflation, right? So on average, you can have a 7% growth. With different products, they have different growth potentials as well. But because you're growing your money, the money that you have gives you more purchasing power in the future. The one point I want to highlight with growth specifically is that when you consider average returns in like the stock market, you have positive and negative returns, right? So you can go, as this example, you can go down 50% and up 50%, right? On average, technically you have a 0% return, but your real return is actually down 25%. So when you have a financial products that have negative returns, average returns mean nothing. So when someone says, oh, this product averages a certain amount, you have to ask them, does this product have the ability to have a negative return? And if it does, their average that they're telling you doesn't mean anything. What's good about this product is that all of them have a 0% floor. There's one product specifically that has a 0.75% floor, and there's different caps, but the one that has 0.75 is also a 13% cap. On average, if you average anything between 0 and 13 or 15 or whatever up above, that average will always be positive. It'll always be a real average that you can rely on. So just keep that in mind as you think more about financial products and stuff like that. With all this knowledge, right, there's the idea that I want to convey, which is, how do you feel about your financial future? The whole point is we're supposed to be building a financial foundation. If we're thinking about life in terms of being a renter, being a temporary user of things, right, it's going to be hard to build a financial foundation. A financial foundation is supposed to be a solid groundwork that you build your entire life off of. So there are like term life insurance policies, there's term temporary, all of the investments accounts are technically temporary. There's nothing holding you. You can open and close them whenever you want to. If you think about your life in terms of those temporary products, then you're going to lose value, right? Because your foundation is not stable. It could come and go at will. So the whole thing is that you have to have this core foundation of a layer of protection that underlies everything. After you protect your life, after you protect the people that you care about, you build on top of that with making sure that you don't have anything against your name, so debt management, making sure that you can actually satisfy any sort of commitments that you have in terms of debt. And debt management and emergency funds kind of go hand in hand. You need a minimum emergency fund, but whether you can get to your actual full emergency fund up front is on a person by person basis how you can manage your funds, right? So obviously have as much as you can starting out, but ideally you should have 3 to 6 months of expenses saved up in emergency fund. So if you have $50,000 in debt and you have $1,000 to your name, obviously you can prioritize emergency funds versus debt management on an individual basis to see like what's more important. Is your $1,000 enough for an unexpected expense right now? And you can sort of reallocate your money as your financial situation changes over time. So being able to have a solid foundation with these 3 aspects, only then should you be able to build that fancy house, get that fancy car, do real investments to like play with your money, right? And when you play with your money, you can have fun. You can also have a better future, right? The whole idea is that you want to have comfort for your life, and this comfort needs to have a solid foundation. Otherwise, it can crumble at any time.
This thing in like psychology, I forgot what
Maslow's
pyramid.
Yeah, it is. It's great. It's you take care of your survival needs and then build up to the things that actually give you fulfillment in life. So protection is protecting your life, critical illness, long-term care, terminal illness, all of the illnesses. So be less like the renter on top and be more like the homeowner down here, right? With your financial foundation. To summarize all of this, right, we have these 4 reflections. We understood how to connect your daily small-scale expenses into long-term goals and be able to understand how much you need on a monthly basis in order to plan for the future, right? We talked about some tax-sensible products. Being able to know what tax category your products lie in gives you awareness into how much value that product is actually giving you. And we talked a little bit about the difference between accounts, products, and services, and the core of like anything that actually has value, anything that is an asset is a product, and anything that you use to track that value is the account that manages that product. And then as services, right, like banks are giving you the service of being able to transfer money, move money around, but they're not actually like holding a lot of value for you. And the key after all of this is understanding all of this information, you can diversify your money effectively and create accounts that work for you. And it's not about having one account for everything or one product for everything. It's about knowing what product meets what needs and what needs you have to satisfy, right? And that's pretty much it. So thank you for your time, and I hope this was a good presentation.